Hi everyone, hopefully you can hear me. The sound is good. Then perhaps in the TradingView chat and the TradingView my chat room, you can interact with me by posting your questions or comments on there, and then we should be good to go. So first of all, if any of you can just confirm to me that you can see my screen. Yeah, that's good. Thank you very much. So there are a few things here that we will initially just point out for you to take notes of, and then in your own time you can go over these and perhaps look at them in a bit more detail. There are few individuals have asked me about any resource for learning about options. So there are two parts to this particular session. One is actually examining the chart and possibly looking at potential trade, but also then to look at how we might trade that using the options. So for those who are new to the options and have very little knowledge about what options are, let me first of all clarify that it is not the binary options. The binary options are a derivative of the proper regulated options. So for example, if you're trading the major markets, you will have all the major players trading that market on official exchange. Whereas the binary options, with the exception of an exchange called NADEX is an exchange for binary option, but most of the other binary options operated by various brokers are actually their own product, which is a derivative of the proper options. So we are not talking about binary options. They have their place, but I think really for most of us, in the way that I am proposing you consider using them, a binary option wouldn't really be suitable at all, and they are too high risk, too costly, and produced by the broker, so who knows what he's doing. They're not regulated, so that's one aspect why I do not warm to using the binary options. But the resources, I've posted the link in the chat room on the TV TradingView chat room. But if you want to take a note, this page here is www.theoptionsguide.com, and there you will see all different categories or headings under which you will find different aspects of options. So you'll find, for example, introduction to the options, what kind of options are there, what strike price, and we'll cover some of these but not in great detail because of our limited time, and how the option premiums are calculated possibly. Then, for example, the expiration time of these options, what happens when the expiration comes to pass, or whether your particular option has moved into a particular price territory. So all those different things you will find in there, which should be quite informative for you to just go through. The other one is this one here under Investopedia, which is the very, very basic elementary, but still useful. You'll see in the page below here is what are these options, why use them, how they work, so etc. So you should be able to explore that, and that is at investopedia.com, university/options. And then the other one is this one here, Investor Place, and this one is a little bit more in detail, much like this particular website, but this one will take you through again similar kind of categories within the use of options and how the options are priced. And within pricing the options, you have a particular reference price, and then how long the time of the options is before it expires, and then how volatile is the market. So for example, if you find the market is moving very, very fast, either up or down, it would tend to have higher volatility. Okay, and sometimes during that high volatility, the bid offer price also increases, just like any other market. And when it is very, very quiet, the volatility is very quiet, then the let me just actually come out of that. So when the stock price, sorry, when the market is very quiet, the volatility is quiet also. So the bid offer spreads comes down together, and secondly, the potential price you have to pay or what you would get also narrows down. It sort of reduces. Um, so there are different aspects in here, and once you go through them, you'll be able to then understand some of the concept of using options. And I'm not expecting in any circumstances after today's session is you become expert at trading options, but I think this is like an introduction, and more from the point of view of practically, if you did show an interest in this area of investment or trading, in practical terms, how it might help you. Um, not necessarily with the Bitcoin, because at the moment there aren't formal options available on this, but maybe, who knows, in the future we could have possible tradable options. Uh, but it doesn't hurt anybody to actually learn about this, and possibly also have a secondary trading activity where you might be able to take advantage of a particular market price. So so useful to go through, and I would encourage you to go through that. Maybe in the future we will run some other sessions. um, then for example, there are different strategies here talked about. For example, simply buying or selling a particular option. So you buy a call option or buy a put option, or there is a strategy where you have a covered call. It's a great way of actually riding a trend and reducing your risk without exiting the market. Then there are others where you secure a cash. So there are so many different ways of simply using straightforward option, which is the call option or put option. That's it. There is nothing else, and it's a question of how you mix them makes your trade, and we will look at that as a sample using the gold chart. Okay, so those three references, which I would ask you please to just go through them in your own time, and then if you have any specific questions, you can interact with me on a TradingView chat, or send me an email at trading the charts, so sorry, trading charts for wealth, and I will post the email address in the chat box at a conclusion, so you can send me an email there if need be. Okay, if you feel that you don't want to share your personal comment on there, but you want to address a question and you want me to attend to that, then I will do that if you send me an email to the email I will post at the end of this session. Fine. So let's move into, first of all, looking at the chart. So I will now forget these three tabs here. I won't refer to them anymore. This is the chart that I published, and in that chart I have outlined this particular chart. I published, I think yesterday, possibly, yeah, yesterday. And the way we are going to analyze this is what trade opportunities available. So this is a rather short-term chart. In this short-term chart, you see it's based on 8 hour. Why 8 hour? Well, no specific reason other than having adequate data on my screen for me to at least explain what I'm doing. If I have a 4-hour chart, I'll have to squash them in. If I have a daily chart, then maybe you can't see my. You should be able to see the chart. Might take a little bit of time because I switched over from those pages, so you should be able to follow me through. Because in the when I was sharing still Google Plus. Oh, were you not able to see those web pages that I had previously? Let me see. Uh, um that is strange. I'm not sure what happened there. Hmm. Okay, can you see the screen now? No, you can't. Only audio. Hmm. I wonder why. Um, yeah, okay. So just double check again. Okay, great. Okay, sorry. So my apologies, really. It's rather disappointing. But if you're able to see them, okay. So just let me very quickly go over. Verbally, you heard what I said, but very quickly, there is this particular site which is the option trading guide. The options guide.com, and then we have the second one, which is investopedia.com, and that one is very basic, but it's still useful because it's got about 6 or 7 categories there that you can go through. And then the most important one is this one here under investor place, and how to trade options, option trading basic. And there are a whole host of sort of a subject within the options to give you some general idea and sort of get you up to speed in understanding what options are, how they work, how to use them, etc. Okay, so have a look at them in your own time, but we'll go into looking at the chart for the gold. And this is the gold chart that I posted, and we are looking at a possible trading opportunity here. From my previous videos, you will have gathered whenever we have a triangle, that triangle takes place, and this is a very distinct kind of a triangle. Uh, exactly where it starts from, I am a little bit mixed up myself, because, for example, do I start this triangle from this point, like I've done here, is A, B, C, D, and E, in which case the triangle finish, we should then move to the downside? Or is this triangle the other way around, i.e., it's actually started off uh, from this point, from B? If it starts off from B, then maybe what we will have is A, B, C, D, and E. It will coil and then break to the upside. Okay, so I'm not sure which of the two will actually play out. My feeling is that this is already finished, and we should be really now breaking next week. We should be breaking this triangle to the downside. So that's my expectation. But if I'm wrong, then chances are that this triangle could break to the upside. But the larger picture of gold is, let me explain to you using this weekly chart. This is a log scale chart, and it takes the gold price back to 1972, I believe, or 75. I think that was the time approximately. Maybe we don't have a data before that, because I think in the time of President Nixon, the gold price, or gold rather, rephrase that. In 1975, in President Nixon time, the U.S. dollar, which was pegged to the gold reserve, gold standard, that was disbanded, and so dollar was allowed to float freely, and consequently, gold prices then started rising very steeply against the dollar. So I am not sure if theoretically or in practice we would have had a further price data here, for example, because historically, generally we know that gold prices continue to hold. Okay, so I'm not entirely sure what might be. Would it be that, for example, or would it be that we have even a further price going back to maybe something like coming up to that in that sort of way? So maybe something like 1, 2, 3, 4, and 5 kind of a thing, or maybe 5 wave within here to make that wave 1, wave 2, wave 3, and wave 4. So I don't really know how overall to interpret this because we don't know this element here. But what's important is the area we are looking at. We know, for example, that that was a significant low back in 1976. And then gold ran up from there, made a top at about 850 area in 1979, early 1980. And then after that, gold spent all that time in trying to retrace that massive move up. And it was only here where gold actually bottomed out, which was in 99, around about September 99 is when gold bottomed out. And after that, gold has been generally in an uptrend, with the exception of what we've got here. So I put this pitchfork on because that was a significant bottom. Using the full entire swing is interesting that whilst the price hasn't been completely captured with that pitchfork, is that we went out of that, depending where you hook that one, but I hooked it at the absolute low. If you were to hook it here, it will give you slightly different representation. But if you hook it where it is, then potentially what's happened is gold price tried to make up, fell back, and then eventually recovered the pitchfork, and then it righted the pitchfork. Because this, if I take this line away, you'll see that it righted the pitchfork and actually used that as a support, and we've come back into the area, marginal breach, just like over here, but we're back into the area where possibly we can have a support because either the gold has bottomed or it will probably spike low and come back to this parallel trending channel that I put in there, which is a specific distance away from here to catch the lows, higher lows along this area. And then subsequently you expect when it comes back into that area, we should expect again that line to become active. So my feeling is that longer term, and I'm really looking at longer term, possibly say minimum next 18 months to 2 years possibly, is that whatever happens here, it is very unlikely that gold will just simply collapse here. It's very unlikely. Okay, so my feeling is that rather than collapsing gold, is gold will either come down, support itself back on this rising trend line here, and then continue higher. So if you look in next 12 months to 18 months to 2 year, gold prices should be closer to say 16, 1700 to maybe even 2000. Okay, there are some people who are saying gold should be at 6,000 and 8,000 and etc. with inflation adjusted and all that. You know, they can work out a possibilities. I don't think based from the chart that it is likely to go much beyond 2000. We might go up to because in Elliot wave theory is that if we had this move starting from here, and I believe that what we've got so far is this, and I'll just quickly mark that out. I'll make it in green so you know what part of the chart I'm referring to. Okay, so what we've got is we've had this very first leg up, which is not massive, but it is still relevantly strong leg because it started off from about 250 or just below 250 approximately, and it went up to something like 323. So that was the first leg up, and then we sort of spent a lot of time retracing that back. So if I was to number this, then I think this is the major number one within this particular cycle. This one is a major number two, and then I think this particular top, and I'll explain that in a moment, this particular top I think is a wave 3. This one here we are coming back to is a wave 4, and therefore to complete this cycle we might be going to make wave 5. Okay, so the guideline for Elliott wave theory is that if you measure the distance of price travel from where the wave 1 began to the top of the wave 3, and then project it from where you think wave 4 is ending, then it should give you likely targets for the wave 5 completion. So in this particular case, we could be looking at anywhere in this area, anywhere in that area. So it could go back and retest the all-time high or stop just short, just like the chart in the Bitcoin we were looking at yesterday, that it could make this wave 5 because the wave 3 is very extended and very long. So wave 5 actually could become truncated, in meaning it could go up and stop short and then come back down. Okay, so that's one possibility. The other possibility, it make a double top. And the third one is it makes a new high. So in general terms, Elliott wave theory and guidelines suggest that if you measure this distance from 1 to top of 3, project it from 4, then the ideal expectation is about 50% distance of that entire move. So that would project it to approximately 2000, just shy of 2000. Actually 50% comes into 2000 exactly, and then if it becomes 61.8%, then that takes you to 2200, and in exceptional strong circumstance, if it makes it 1-to-1, then we are looking at 2800. So I don't think somehow that we will get to 2800, and by nature I tend to be conservative, so I don't want to start going really wild and give you a target that is going to be almost impossible. But I think if you aim for gold hitting around about 2000 to 2200, that's a good probability and an outside chance of possibly 2500. Okay, now the reason why I say that is because using the same concept like we've been exploring previously in our other sessions, is whatever started from this move is effectively, kind of a either way, this is the log scale you'll see. So whatever started from this move here is capsulated by basically this rising trend line as a baseline, and we've not come back to the baseline except now. So one would expect that that would be like wave 1, wave 2, we've gone to 3, and we're coming back to the baseline for wave 4. So that's a very quick way of saying it. The other way is that if I was to put Elliott wave, not Elliott wave, but the MACD on it, because MACD, as you know, is not bound by the upper and lower limit as being 0 and 100. And if I was to show you on this one, you will see the Elliott wave guidance also says that the wave 3, so we started from here somewhere, and this is a lot of squiggly lines, I know, but if you just simply look at it, that the high of MACD is here. And generally, the wave 3 is supposed to be the strongest, and it's supposed to have the highest momentum, which we can see MACD went the highest distance away from the 0 line. So that is reasonably conservatively concluded as a possible wave 3. And then the second point of this MACD is that on a wave 4, it at least drops back to the 0 line, but more often it actually goes well below the 0 line. So what you see here is we've got first swing down that actually dropped below the 0 line. It tried to go back up and had a secondary drop back. So this is a real clean indication that possibly wave 4 is now finished, and that we are now, on the wave 5, and we are probably at the beginning of that. So that's like a big picture view, and we'll look at a smaller time frame in a moment, but that's a big picture view suggesting that wave 4 is possibly over, and we should be now starting on a wave 5, either have started or will do shortly. So let me take the indicators that I don't want out for the time being, and we'll drop down to the daily chart. Now, by the way, this is not with a hindsight, and I don't necessarily profess that I know everything and that I get every targets right. However, in the chart that I published, which you'll see on my homepage, if I can take you there, on my homepage, you'll see this gold chart here. You will also see on that gold chart there are these other previous postings of my gold chart, taking you over 18 months to almost 2 years. And when the very first chart was posted, I have actually followed gold chart from earlier. But on the trading view, this is the first gold chart I ever posted, and when we posted that gold chart, where we were was approximately here. We were approximately in this area here, and when we were in that area, I made a comment. I made a comment that it is very critical for gold price to hold that, and if it didn't hold, then we are looking for, you know, I think, was it like that? Can't remember the actual line. I think maybe here. Maybe the line was drawn from this low, going across there. I think that's what it was, or even a little bit further back down. Anyway, you'll go back and you'll check. You'll see that when I posted this, I was saying that this is very critical for gold price to hold. If it was to give this one up, then we are looking for a much deeper drop. And you know, I have always been conservative, so I don't go wild. But my initial expectation and absolute minimum was this low range to be retested again. This 1500 to be retested as a minimum, and I also said that it will probably drop down to 1400, 1400 as a round figure, right? 1400. So you know, when we went through that, 1400 was taken out. I then subsequently posted the updated view, and I had been targeting around about 1200 to 1150 range. Okay, now we've hit the 1200. We didn't quite get to 1150. So that was my overall expectation. So if I look at this now, a little bit with the hindsight, but also with the fact that I had actually projected these targets well in advance of ever getting there, what I see here, based on Elliott wave, is that we've had, and with a price pattern there now is a lot clearer than when I was looking at it at the time when I was considering. But nevertheless, I had a general concept. So we had this like that, and it's called a leading diagonal because it is like a contracting triangle, and it is, and the reason I'm explaining this is because there's a logic to my big picture view, and it's a big picture view that I want to really try and crystallize. Because if you were going to trade these options, there is a way of making a lot of money without a huge amount of risk. And you know, by the way, it's not a recommendation, but I'm simply exploring possibilities to illustrate something. Okay, so that was the wave one. Then what we had is a series of lower lows, very sharp, you know, impulsive moves. And the way I was looking at it is, if that was wave one, I'll change the color to that one to red to say that this is now, you know, sort of move we are trying to plot downside. So wave one, wave two, and then we had this drop down here as wave 1, 2, 3. This is a strange kind of a thing looking 4 and 5. So take my word that I am calling this overall a wave 3. And wave 3 is supposed to be the strongest and longest, and everything else lines up. And this here looks strange because it's actually a running flat, right? The running flat meaning that we have a wave A up, wave B down, and wave C should go back up here because the price momentum was so strong. It doesn't have the wherewithal to get that far, so it stops here. So it's called a running flat. So it's correcting in the direction of the overall trend rather than doing a normal zigzag. And then this final one is a wave 3. So if this is a wave 3, then you can see this one's ABC back up as wave 4. And then during this time, I was in two minds, not knowing exactly what's happening, but I have actually still tracked it, and I think we have the bottom. We have the bottom because there are many Elliott wave practitioners and other technicians. They're saying that this is a big wave 4 of down wave. So in other words, if I was labeling this one, then say for example this as a Roman numeral 1, Roman numeral 2, Roman numeral 3, Roman numeral 4, that's where I think it is. But they reckon that this is Roman numeral 4. Okay? Now, I don't think that is the case, because what has happened subsequently. So that's the subsequent price action is actually now a real key to the puzzle, why I think we have bottom. And here you see it looks more like a zigzag, just like this zigzag. So I can understand why many people are saying this is wave A, this is wave B, and this is wave C. And in this wave C, we've got 5 waves. We've got a clear 5 waves because we've got this moving up to there in bullish 5 waves to make it blue. So moving up to there, then we go wave 1, wave 2, wave 3 to here, wave 4, and wave 5. Okay, so that's a clear 5-wave move, and it is, if you see it very clearly, it is actually what we call a leading diagonal. Okay, the leading diagonal meaning that this is the first move, and there's going to be another move higher up in due course, not right away, but in due course. Just like over here, we saw the leading diagonal, which is the bearish. So we had leading diagonal retracement, and that meant there's going to be some further downside. So that's the key of this particular overall chart. So if this is a leading diagonal starting from here, then we would expect a retracement, and I think we've got that, because if this was not a retracement, then we should be expecting another weak point to come back down. Wrong. Okay, what we were expecting is another strong 5-way move to the downside, and we are not having that. So my original analysis is correct, and the way I had this is the most confusing part is actually coming down to here, and I'll change the color to green to tell you that this is the minor waves we are counting. Okay, so this is the wave 1 down. If this is wave 4, then we want 5-wave move to conclude for this final bottom. So we had a wave 1 down, minor wave 1, then we had A, B, and C, so it's running flat again. So that's a wave 2. Then we had a wave 3 down here, and then again we have running flat, minor running flat, and then finally wave 5. So it doesn't look right because of the running flat distorting the picture, but basically that's a 5-wave down. So we've got a low, and the Elliott wave guidelines also suggest that between the bottom of wave 3 and the bottom of wave 5, we should see RSI divergence. Well, you can see that quite clearly. Okay, so those things line up, and the wave 5 came and just marginally took out the low. In fact, I was watching somebody else's presentation, and he was saying that based on the futures cash contract, I think it actually took out that low by decent amount. But on this particular chart, it appeared as though we might have just only by just a few cents, not significant. So we've had a double bottom, and then we've had a 5-wave. So this 5-wave, I think, is a new cycle that has started, and it's the first wave completed. So if that wave is completed, is correct, then what we should expect over a longer period is that we get this retracement end somewhere here, and then we go back to producing a new bullish cycle to the upside. So I'll change the color of that to blue again, and so what we should now expect is something like this. We should go, wave 3 should be very strong, right? It should be strong and steeper, so we can see the steepness of this one. So wave 3 should be even stronger, and then along the line we'll get some retracement, and then one final leg up. Now exactly where it's going to go, as I said, we can't be absolutely certain, but we're expecting in general term to go back and retest the high or make a new high. So it may be that this wave 3 could actually take us possibly to here, this area. Then we may get this retracement, and who knows how long that retracement is going to be, but this is what I'm just sketching out as a general idea. So wave 5 will take out the previous high. Okay, so for time being, that would be good enough to give us a 5-wave move up. So in this particular case, there are 2 special trades that we could line up. One would be is to find a low and just simply buy gold. And you can buy gold by whatever normal means. You can either buy physical gold, or you can buy a futures contract, or buy some other ETF funds, for example, gold ETF funds, uh, depending on your particular requirement and your account size and your skill levels and etc. Buying a futures contract is very heavy. It's a large size. You'll have to go onto a CME website and check out what the contract value is. But I think you'll gather that most people would not be able to handle a futures contract because it's too big, and you'll get a leverage, so people are able to buy on margin. But then equally, if you get it wrong, margin futures contract, if it goes against you, you'll be swimming, and suddenly before you know, you'll be drowning. So if it goes against you, even if the overall analysis is correct, but somehow price lingers here and frustrates everybody. And 1 minute is trying to make up, next minute is trying to come back down, and you begin to think to yourself, where is this going to go? And if your leverage position was so heavy, then you'll begin to panic, and you'll probably panic out like everybody else, and exit and take a loss, and the gold will go the way it wants to go. But anyway, this would be approximately the price that you can look to enter. So in general terms, if we are looking for typical retracement, then from the low, we'll be looking for the general retracement. So we've already done 50%. So 61.8% is approximately at 1260. And if it does a 78%, it could drop down to about 1200, about 1240. So I think around about 1240, 1250 area is probably a good area to look for possible long position, right? But then you can say to yourself, okay, well, in that case, I'll wait for that. So that's fine. And you can by that time, you can actually work out, do your homework and work out what instrument you will use to buy gold. You can either buy gold stocks. There are some mining stocks, for example, that you might be able to buy, or you might be able to buy some options on mining stocks. Or you might say, well, it's hard enough trying to trade one market by analyzing gold, and then to make it complicated by having some mining stocks, because who knows what the fundamentals for mining stocks are. Maybe their minings are not producing as much, maybe they've got other problems. So you get to add another layer of uncertainty. So you might say, well, in that case, what I'm going to do is I'm going to simply just play the gold, and forget about the finances of the mining companies and what risk they're taking, and whether their COE has got some adverse publicity coming out, or have they've got accounting irregularities, any of these kind of things. So you might say, well, forget about that. I'm just simply going to go with gold price. So if you go with the gold price, then having gathered this as a background picture, I'm going to take off most of these drawings now because we don't need them, and we're going to now look at just this area here. So I'm going to drop down to now 4-hour chart. I can't do a 4-hour chart because the end of day. My apologies. I will drop down to, well, I can't drop down anymore. Only a 1-day chart. I do have a gold chart though on my MT4 platform, and maybe that could, and it's already 4-hour, so maybe I could just illustrate that, and then I'll swap back to the other one. Okay. So what we see here is we had a drop down. So it's a 5-wave down. 1, 2. Let me just show you that. So it's 1, 2, 3, 4. Sorry, 1, 2, 3, 4, and 5 to give you wave A. ABC retracement back for wave B, and then again a 5-wave down to give you wave C. So we've got ABC. So it's given me like a W. So that's a 1 zigzag. Then we have gone up here, and I was puzzling myself as to what kind of a wave this is. But if you spend enough time on it, you'll probably find what it is actually this element of it is an ending diagonal. That element is an ending diagonal. So in essence, what we've got is we've got 1, 2, 3, 4, and 5 as a wave 1, or it might be A, B, C to give you W, X, and then 5 wave up. So it's A, B, and C going back. So in general term, just consider that as a retracement of this entire decline. Okay, so we've got another ABC down here, X. So we are now looking for another ABC to the downside, and what we have here is a first drop which looks like a leading diagonal. Then we've got this contracting triangle, and that's what I was trying to say is exactly where do you count the triangle. Do you count the triangle by saying that this is a first leg up, and then you have A, B, C, D, and E? If that's the case, then next week we should see prices moving up strongly that way, right? But if that is not the case, and if I think it is, then we already have the top here, actually top over here. So because we've got this wave A, wave B, C, D, and E, so top is in. So we've had a first drop, a retracement, and we should now start picking up steam, and we want that possibly to drop. So if you look at it, we could have, if you have the same distance, so you get like AB equals CD move, AB equals CD move, then maybe that sort of thing here. So that's giving you possibility of coming to this sort of area here. That's around about 1220, 1230 area, if this is AB equals CD, okay? But the fact that this triangle happens in one place, so it's a question that we need to ask ourselves, where is it? It happens in one place, that means it's a continuation pattern. And as I've just explained, depending on where you start, you think that maybe the bottom is here and you will go up, or possibly the top is here and it's going to go down. So because we are uncertain, I'm going to take you now to possible trading opportunity on using the options, and I'll go back to the trading view chart. So on trading view chart, wrong one. On trading view chart, so if we have this as a triangle, okay, and we've already outlined that depending on which way triangle breaks, if the triangle breaks to the upside, then we know what we have here is effectively A, B, C, because we had this A here, this whole triangle is a part of B, and we're going to make a new C, and then the price will drop from there like that, okay? So that could be one possibility. The other possibility, which I'll outline in red because that we are looking for a bearish kind of a outcome, is that we already have first leg drop, then a triangle. So we're saying there was a trend to the part leading into the triangle, so we should have an outcome of the triangle which takes you straight down here like that. And in either case, we are expecting possible move like that. So if you then clone that, then we could be looking for a down move like that. And with your Fibonacci's, we were saying possibly, you know, maybe that might be too deep, but certainly an area around 78%, 61.8% could be useful. There is one in here, I just need to take it off. I think it's actually complicating. I need to take this 70 off, okay, because I don't believe in 70 particularly. But you know, we're looking for 78%, so that brings you into an area about 1250, 1230 area, or maybe 1250, anywhere in there. So either a blue outcome, and then the final resolution of any of these is he's going to go back up. That's the long-term outcome we are looking for. So in this case here, if you were to go short and you found price going up against, then you will suffer an adverse drawdown on your account if you've gone in a leverage form. If you've not gone in on leverage form, then your account is relatively big, and then you can take a large position size. And as I say, you can't take a gold futures contract, so you'll have to find a GLD, like a gold equity traded fund, to mimic the price of gold, where you can buy exactly what you want using your account size, then your risk management and so forth. You don't have to buy a futures contract, in which case you can buy 1 share of GLD, or you can buy 100 share of GLD, or 1,000, depending on what you want. So if you didn't do it with a leverage account, then you have to have a large enough account to have a reasonable position size to make a difference. Otherwise, all this work and you get everything right, but in essence, the result in dollar terms or in money terms would be such that it would be disproportionate to all the effort you're putting in. Okay, so if you're going to get some kind of a leverage, then okay, you can take a slightly larger position, but the risk increases of getting it wrong and being able to withstand possible adverse excursion, knowing full well where the price is going to go. So to trade that uncertainty, and not only to trade it with uncertainty, but actually make money, and possibly using somebody else's money, which many people say use somebody else's money to capture. So using gold GLD and using an option on that, I'm going to now show you how it might work. Okay, so straightforward, if you want to sell, you can sell here, put your stop at the top, but then, as I say, if you get a leg up, then you'll be wondering, and you'll be possibly under strain, and you might even get stopped out. And if it works in your favor, then fine, you got a great run, and you'll be able to make money from where the gold is now at about 12.90 to a gold falling down to somewhere in the region of 12.30. It's about $60 difference. Okay, but as I say, it may not make a big difference if your position is too small. So let me take you to the gold GLD, and this particular platform is a Trade Monster platform. If you're all wondering what it is, if you simply go into this here, www, it's a trademonster.com. It's a US broker, and likewise you can also check out Interactive Brokers. Interactive Brokers have it's a US broker. It has a presence in several other countries, including UK. So UK client may want to open up an account with Interactive Brokers, but the problem with the Interactive Brokers, they don't give you a demo account. You can have a demo account, but you have to have a live account with them in order to have a demo account. So that's a bit of a withdrawal. But if you went into Trade Monster will give you unlimited demo account, and it will give you price which is delayed price. But that's fine, because for the purpose of testing and learning, it doesn't matter whether you get an absolute up-to-date price. It's lagging by about 20 minutes or so. So it's no real big deal. In the scheme of things that we are looking at, it's more than adequate. So you can go into that one. You can go in and open an account, demo account. These are proper accounts if you want to open up. You can do a demo account, paper trading account. Also, just to point out, if you went on to this education section, then like the other option programs or material that I pointed out, on this education program, you've got some free webinars that they run. You can attend if you want to try and familiarize yourself a bit more, both with the platform and possible trading. There are different types of webinars. There are some which are based on just general trading, and this one is on using their platform. And they've also got archived webinars. So if you don't want to wait for the future event, you can go and select the one that you want and view them. So it's useful in that particular sense. But you can have a demo account on here. Okay. Now I've opened up a demo account, and then once you got it, you sign in. And to open up a demo account, all they need is your email address and your password that you create. Okay, and you've got a demo account available. So you then launch the trading application, and this is what you get, right? So you can see I've already planned few trades here. I've got this one, which is a trade I'm going to describe to you. Okay, so if you look at that, if I click on that one, it is saying what I'm doing is, and I'll just write it down so I know for myself what I'm looking at. I'm looking at a big play where I am selling one contract, and I'm going to sell a contract at 130. Oh, sorry, buy contract at 130, and then against that I'm going to sell one at 135. Okay, but the one at 130 is a December 2014, and what I'm selling is at 135, but is a longer term. That one, okay, no, it's the same. It's the same 2014, December 2014. So it's the same expiry date, but it's a different price. So I will explain why I've done that. And then on the downside, I am buying a put option, which is at 125, and I'm going to spend a bit of time on that actually to help you understand. I'm buying a put option 125, and it is again December 2014, and then I'm selling against that one 120, selling against that 120 for December 2014. So it's all December, and I'm selling. So this is just one strategy. So let me now take you onto the chart again and try and show you, map it out effectively. Where is it now? Okay, so if I take all of these away, and unfortunately I can't give you okay, no, let me just take these away, clear these out. Okay, so what we are saying is that if this was going to break out one way or the other, we don't know which way. I think it's going to be down, but we're not absolutely certain. So it's going to break out that way, or it's going to break out that way, right? Initial. We know subsequently it is going to go down from either from there or from here. But right this moment in time, we don't know whether it's going to go up and then down or straight down, right? So I'm going to put horizontal line where we have the actual prices. So the first price is at 135. So 135 is saying that 135 is approximately here, okay? And the next price is at 130. So 130 is around here approximately. And then on the downside, we have 125 approximately there, and then 120, which is around here, okay? So I'll just put the coordinates in there now correctly. So this one is 120, 120, right? And then this one is at 125, and then this one here is at 130, and this one here is at 135. Okay, so these are our parameters. Okay, so what I'm trying to reason to myself is, if this price broke out to the upside, I'm not expecting this one to go too far away from this level here, which is about 130, 1,350. And if it, so in fact, what I'm going to do, I'm going to change the colors now. So the one that I am selling is, I'm selling this one. So I'm going to keep that one. Actually, let me put the labels on there. So I'm says this one is going to be a sell. This one is a buy. This one here is that one is a buy, and then this one is a sell. So if you ever come across a time when you don't know exactly, you know overall what's happening, but you don't know exactly where it's going to go from, then this strategy could be very useful. If you knew absolutely where it's going to go, then what you do is simply, and in fact, what I'll do is I'll change the color of the one that I've sold to red, like that. Okay, so if you knew exactly what direction it's going to take, then you simply buy a put option. So these are call by the ones on the top. Ones on the top are call option, and I will highlight the call option by saying it is wrong one, blue, and then the one that has put options are these, and those I'm going to identify them by saying they're that color. Okay, so that's the color I'm using. So what I'm trying to say to myself is, if I was to sell right here and the market goes up, I'm in trouble. If I was to buy here and market drop down, I'm in trouble. So what I'm trying to say to myself is, okay, I don't mind buying a position for 1300. So if the market goes down, I'll be losing, but then I'm also buying a put option. So I'm going to buy put option. So if the market goes down, I'm going to be gaining, but then I'm going to be losing with this one, but that's fine. But against that, because if I buy a put option and the market goes up, then I'm going to be losing money on this one. So what I'm saying now is I'm going to be buying that, but I'm going to be selling this one. So I'm going to protect myself. So I'm going to protect myself. So whichever market goes, I'm going to protect myself so I don't get completely wiped out. In other words, that's the strategy. Okay. So these ones are call options. And call options, I'll make them into blue color. So that's a call option, and that's a call option, right? So those two are call option. So what I've done is I've said to myself, in the next few weeks, it's unlikely that the price is going to drop down below this low, because we know that this is a 5-way move up. So we're retracing, and we're only expecting price to probably come to about 1230. That's where we're expecting. And in fact, we should put a line where we think is going to come to, and that's where we think line is going to come to. So what we want to try and do is we want to benefit from the price dropping to that level before going up. Okay, and if it goes up partially, then we are not going to be panicking, because we know we are protected and we might be able to actually reduce the risk. So first of all, what will happen is the position I have sold, if the market goes away from the position, the one I have sold is going to be losing money, and one I have bought is going to be also losing money. But the one that I have bought is going to be losing money is partly subsidized by the one I have sold. So I'm not going to be losing all of it on my own. Somebody else is losing something against my position, so I'm only losing partial of. So in other words, if you were to say, as an example, and it's not exactly the same, but say for example, from this position, if it drops, say you lose $10, then out of the $10, you might be finding that this position will subsidize you by $5. So you've actually only lost $5. Okay, instead of losing full $10, you've only lost $5. But against that, you are gaining, because remember, you bought this one. So as the price goes to your target, you are making money on this one. So what you're losing on the other, you should be able to make money on that one. Now if this one then drops to this sort of position, then remember you sold that. So what will happen is this one will actually drop down in value. So let us see, we'll look at each leg, and let us see how they will fit in. So I'll go back to the, so we are saying we have sold this one, and if the price goes to about 1250 or 1230, what will be the price of the one that we have sold, right? So in here, if I go to the GLD, if I can find it here, GLD, and we're looking at the options, and its market is closed, so prices we see here might not be an actual representative of what the prices would be when it opens on a Monday, but for our exercise it'll be good enough. Okay, and we are looking at December. We are looking at December, and I'll explain to you why December. but we are looking at December. You can do any of the other trades, but I don't want to run out of time in playing my strategy, so I'm taking a December contract. Okay, now in December contract, the one that I have sold is 130. I've sold the put option. This is the put option section. So I've sold 130. This is the one here. So at the moment, if I click on that, it is saying that currently it's available to buy at $8.87, but you can sell it at 80. Okay, so I'm going to now show you what it would actually do if I was going to go ahead and consider that. Okay, so this one is just let me go back, editor strategy, and I'm going to make this simple. I'm going to say you only buy one contract. One contract is 100 shares. Okay, so that's the only thing that in an option, any contract you buy has to be a bundle of 100 shares. So this GLD will only play with one contract, so it's 100 shares, right? So we're going to now go and look at that. To buy the 100 shares, or rather because we're selling this, to sell this 100 shares, we are going to get approximately it's going to be a cost value is going to be $8.95. So that is for one share. So 100 shares, so it's going to cost $89. Okay, $89 currently priced, where the price on the gold is approximately at $12.90. So if the price then drops to $12.30, then what is likely to be the value of that contract? So this line you see is on expiry. So we are not looking at expiry. We are looking at running price. If the gold drops down to 12.30, so 12.30 comes in at approximately about here. Okay, so the one that you have sold to somebody for $8.80, right? $8.80. You're going to find it's going to lose value, and it's going to drop down to like $3. So that means you'll be making $5 on that particular contract. Okay, so the idea would be is that when we see a price drops, when the price drops, doesn't matter over here, because we're using that as a protection, because if this market simply just took off, then we don't want to be completely burnt. We will be well protected, because we will make money on this position we have bought, and we're going to lose money on that one. But the difference between the two is your guaranteed profit. If this price just simply took off, that's your guaranteed profit. You'll make a loss on the other side, but you'll be making money on this one, right? But if it didn't do that, and instead if price simply went up there is nothing to worry about, because you're fully protected. And then if the price drops to this area, what this contract you sold for $8.80, this one you sold for $8.80, for example, is going to be worth, when it come down here, about $3.80 approximately. So you're going to make a $5 difference on that. Okay, that actually belongs there. So when the price drops down to this level, this $8.80 is only going to be worth about $3.80 or $4, or somewhere in that order. That means the profit on that contract could be $5. So if the price has gone up to here, then what you could do is you can let that leg go. So if you let that leg go, then we make that one faint color to say we're going to be making money on that one. Then this one is going to be losing money, but you already made $5 on this one, so that subsidizes you any losses you made on here. But then the downside, you'll be making money on the one that you have bought, and you'll be losing money on the one that you have sold. However, this one that you have sold, we'll look at that now and say it's at $120. So if it's at $120, so we'll go back and we'll look at edit strategy, and we are going to be looking at a put option that we are going to be selling. So here, instead of buying, we're going to be selling that put option. So that put option sell, and we are looking at that strike price at 120. Okay, so 120, that's a strike price. So the price they're quoting for that is, because you're selling this, right? So you'll be getting like $370. Okay, so if it's a $370, and you simply look at what will happen if the price drops to 120 from where it is now. So let's find where the 120 is. 120 is approximately here, right? So what you have, yeah. So what you are currently selling for 370 is going to be worth. You see in that orange box in the middle, theoretical price, it says 527. So you will be losing $2 and $22.50. Okay, approximately you'll be losing. Theoretically, this is $2.50. You'll be losing on that position. But on the one that you have bought at 130, because on this chart here, on this chart there, see, this is what we have bought. So you'll be losing about $3 something for that position, but you bought this one at 130. So the price of that one is now going to be, you bought this one at 130. December put option is about 875. So if the price then drops to sorry, we're gonna that, okay, that's better. So because we have bought this one 875, so the price, if it drops to 120, is going to be worth approximately about there. It's going to be worth about close to $12. Okay, so if you paid, say for example, you paid $9, and then you're making $3. So you're making $3 on that one, and against the one that you have sold at 120, if it gets to 120, 130. So if you get to 130, then you'll be, what you have gained from somebody, 375. So you will be making $1 on that one. Okay, so you made already $1 on there. And what was the other one we said? About dollar on that one you're going to be making, and you will be, sorry, you'll be losing $1 on that one against your position on here, where you will be making like $5. Okay, so you've lost $1, but you're making $5. So net effect will be you'll be making $4. So on this particular chart, then, if the price drops, from here, then just on these two pair, you made $4, right? And against this one, remember we said we would buy it at 880, but will be, when it drops down to here, the value will be 380. So we will buy it back at 380. So you'll be making $5 on there. So effectively, you'll be making $10 move if it drops down to here. So although the price drops from 129 or 1290 to about 1230, is about nearly $50-60 move, but you are doing this one in such a protected way that you will actually be making only $5 per share. Okay, but the beauty of this is that once it bottoms, you will be able to buy a long-term position with which we'll look at in a moment. But in terms of, let me just now, we looked at all the four legs. Let me just give you one combined position, so then you know the net effect if it's going to come down. Say we close everything, but the idea is that we won't be closing. We'll be keeping the one that are profitable going for us. Like for example, when we are on when we are priced over here, then we'll be exiting from this one. We'll be leaving this one out, so this will go and actually expire. So we'll be getting the full money out on this one eventually, right? And then this one will be buying back, so there'll be no more risk on that one. We've already got one long contract going, and we'll be adding some more contracts. So we'll be legging them out So we'll actually only we're saying here we're getting $4, but in essence we've got every expectation that we'll be collecting the full money for this $8 we have made. So we'll be making $4 on the current trade, but then the remaining $4 we'll be collecting as well. So the idea is that we'll be collecting overall $12 to the down move, and that's where the money begins to pile up, because the $12 down move and $4 on here is $16. So if the price dropped from here to 230, you'll be making $16, and you've got this leg for free. It's already paid for from the profit you have made. So let's now look at, in theory, if we were to close everything off. So I'm going to go back to that position that I had on GLD. So on account, and say on the orders. So this is the one that we have created, and it's currently still in the market order because the current market price at 367 for the whole entire 4 legs. I have to pay $367 to enter, and I'm currently bidding it for 350. Okay, so if I get it filled at 350, fine. Otherwise, I may have to fill it in at that place. But assume we get 350, right? So if we now look at copy that, and I'm going to show you how all the legs together will actually work. So forget about what kind of a trend this is, but if this, I'm going to be putting online a total cost of 350 for each share. So if you have 100 share, that'd be like 350. Okay, so $350 is what my total risk for trading this particular strategy. So from here, where the price is at 130, so if the stocks move to 120, right, then if the stock moved to 120, then you can see my total position will be worth about 138 to $140. Okay, so that means basically everything that I've paid for, I'll be able to collect it back. That means I've taken no risk. I've not made a huge amount of money based on that if I just exit everything. Okay, but the idea is not to exit everything. The idea is to get all your money back, maybe make some profit, and then still leave you with this position running for you. So this position here is paid for, completely paid for. So you've taken no risk and you made some profit, you booked that money in, and you already paid for this position, and some of the profit you've made, you'll be able to use that to buy some position higher up. So for example, if subsequently we think once this price has bottomed here, then the price is going to go all the way to there, right? Then you could either wait until it bottoms then buy, but by doing what I've just suggested is you've already banked some profit, you've got a free leg already going, and then the money you have got from the profit, you'll be able to buy far out of the money position, right? So you could say if this market is going to go to 1700 or 1800, then maybe what I could do is I could buy somewhere over here. See this structure low? So say it goes to about 1500. So you can try and buy a position at 1500. Now at the moment, the price we look at might be not a correct price to show you what 1500 contract would be, because when the gold drops to 1290 or 1230, getting muddled up. So when the gold drops to this level, the 1500 contract is going to be even less in price. But if you just look at where the price is now and just see where the what you might be expected to pay, is we'll be looking for that we want a very long-term trade. Okay, so we're not even looking for January 2015. We should be looking for a trade much beyond that. And let's see if this one gives me any more prices here. So January, okay, it hasn't given me one, but say for example we go for January, but we should be able to pick up a trade for like January 2016, that kind of long-term trade. But see, if we just go for that, and then we are looking for a put position, call position rather, call position, and we are looking for buying 1500. So we'll be looking for 1500 here. So at the moment, see, it's only about 50 cents, 50 cents to 60 cents, right? So say if you bought it right now, but you'll be actually able to buy this cheaper. If it drops down by 3 or 4 strikes, you may be able to buy this one for something like 20 cents or even 15 cents. Let's say call it 20 cents, right? So let's just look at that, and we're going to now buy one option, one call option, and say in here we are going to be finding that eventually when the price drops we can buy it at 20 cents in, right? And then say look at the price overall, and say by January, so you bought this at 20 cents, by January say the price begins to creep up and it actually comes to it say by January we are back toward like 1400. Okay, by January 2015, say we back to about 1400, not even at that target, but say 1400. Then effectively what you'll have is this trade then goes to 1400, underlying price at 1400. So it's going to be worth about $5. So what you bought for 20 cents is going to be worth about $5. Okay, but if we were able to, I don't know why we don't have a longer term trade than that. It's only January 2015. I'll have to check that. But my idea would be is that even if you got this and say in January the price doesn't get to 1400, but it only come to 1300, right? So it's 1300, and on the chart you can see where that is. So say by January the price only comes back to approximately where we are now, right? So in that particular situation, it just comes to here. So what you spend 20 cents is going to be worth about 130. But if the price goes to 1400, it will be worth like nearly $3. What you paid, so that's like nearly how many multiple? If you multiply by 10, is $2. So this is like 15 times the money that you laid out. So if you only laid out, say for example you do this entire trade of possibly and that is say assuming that you do nothing at all, you simply wait for the price to drop here, and that's when you buy this long position. Say you do that, then potentially what you're looking for is paying something like 20-30 cents for going into a trade. So you buy a bundle of 100, so you're only putting down $20. So say okay, well in that case you can buy a larger contract. Say you can buy 10 contracts. So 10 contract is like 1,000 share. So 1,000 share means you put down $200 trade, right? So $200 trade, by the time this gets to about 1400, $200 will be worth nearly like $2,500. So you're talking about nearly 10 to 15 times the value of your original investment. So do you think that kind of thing could make money? And if you were, say, for example, considering the same sort of thing for a longer contract, and maybe perhaps on in editing strategy, we might actually be able to pick it out on here. So let's do it on here. This is better. So say we go into January, March, January 2016. That's better, right? January 2016 at currently is charging you $3, but we know that when the price drops to 1230, we might be able to buy this one for something like a 250 or 275. So say we 275, say we buy it for 275, and now this is the real deal. Okay, so say at that time you buy it for 275, and you bought again 100 10 contracts, so that's 1,000 shares. So in that particular case you will be putting out 2,750. But if you only went for one contract, then you'll be putting $275. $275. So you start off and say by January 2016, we are looking for this price to go to something like 1600 or maybe even 1700 by January 2016. Remember, it's almost like 18 months from now. By 18 months from now, we know that we are expecting this price actually to go very close to this 17, maybe even higher range. But say it only gets to 16 or 1700. What will be your contract worth at that time? So let's check on this one what a theoretical value would be. So this one goes to 1600. So what you are paying now, 275, that's going to be worth nearly $17. And would you think that if you were able to multiply this by nearly like a what's a multiple, the 5 times, that's a 5 times value. If this one then goes to say like 1700, it will be worth 20 times. So that would be like 10 times, over 10 times. Well, not quite 10, but 8 times, 8, 9 times. And if the price gets up to 1650, it will be worth 21. So it's possible that you could get your money multiplied by 10 times, and you might have actually opportunity to do a lot more than that. Simply, this is just simply buying and riding along. So you might be able to make nearly like a 10 times the value. So your initial 275 will be worth $2,500. If you went in with something like a 10 contracts and you put $2,750 on risk, then you'll be looking for that to go to something like 27, 28,000, 30,000, that kind of money. By the time this one only comes up to here, and the scale on the thing doesn't take us very far. As you can see, we're running out of scale on here. We can't go beyond that because we might be able to, unless if we do toggle that way. Yeah. This is good. This is really good. So say for example, if the price gets to the level we are expecting, almost like $17, $18. So you see your contract that you bought for $275 is going to be worth nearly $37. That's nearly 15, 17 times the value. So your initial $275 could easily turn into $3,600, right? That's the beauty of this position. So the idea will be is that we secure some, while we are trading these, we make some money to give us more money to buy a longer contract, and it's that contract is going to really make the money. But if you feel that this is too complex, which I can't understand, then the best thing is to wait for this price to drop to the level we are looking for, and we are then going to be going for a contract like this, which we think we can get for $275 each, and we have to buy 100. So you'll have to put $275 up. $275 have a potential by the time it gets to January 2016, and we approach this sort of level, then it's going to be worth $2.75 contract is going to be worth nearly $36 in value. If it gets to 1700, 19, this is about $1,900. So it'd be worth $42 then. But if and this is theoretical, but if it only came to about 1700, 1800, it would be still worth $35, $36. And you wouldn't have a lot of sweat. You wouldn't have to monitor your price on a daily basis, even at least in the early stage. And then you might be able to do a few other tricks whereby you do when for example you see a price do this. When a price do this and you see weakness and it's going to retrace, then instead of waiting for your contract that you bought here when the price was here and you bought that contract that's gone into money, you don't want to wait for it to come back. So when it gets to here and you think it's going to approach this resistance, like we tried this one here, you might be able to, against this price which you own, you might be able to sell a contract price over there at this level. So if I put a horizontal line like here, you might be able to sell this contract. Idea would be is that when the price drops here, then some of the loss you suffer on this one will be subsidized by that. When it drops down to this level, this price that you sold is going to reduce in value, so you buy it back. So this then is removed out of your way, and when this one continues, you're able to ride this. So you're able to limit the money you lose on a pullback, but still continue to ride the contract from well below. And I think it's a great strategy, very profitable, and you'll get price like that. You wouldn't have to worry about adverse drawdown or suddenly getting panicked out of the position that is going to ride long position. But this kind of a trade that I'm looking at is essential uh, in that you get your larger term charting and price analysis correct, because we have gone on to longer term and we have so far estimated based on our analysis that we've seen the low and we now should be moving in for a new cycle high to approach here. So we're now trying to capitalize on that. So the way to capitalize is, if you get this one completely wrong, then you lose $275, right? But then we wouldn't wait for $275 to completely disappear. We'll, if we think we've got completely wrong, we try and get out before we lose a lot more of that. We'll get out by, say, $2. So we lose only 75 cents each. So you lose $75, for playing the risk. But if you get it right, then that 275 can go into something like $30, $40 value, which is where real money would be made. And you could then, as I say, play a few other strategies. And there are several markets lining up for this kind of situation. Stock market is potentially at a very critical level where it could be forming a top, and for many months, maybe even a year or longer, we'll be getting like a gold going up. We'll be expecting a stock market probably to come down, and along with that, many other assets will come down. And you can find opportunities all over the place, whether it's commodities like oil, agricultural commodities. When these agricultural commodities in particular, when they move, they have a very fast move, last fairly short time, and therefore you don't have to have like a 2-year contract. You might only take 6-month contract, and sometimes the move will only last for 3 months or 4 months and you're out. But by using the same kind of concept, whether if you don't get involved, my simplest strategy is to forget all of this, right? That's my simplest strategy. And for beginners, if they want to trade this on a what you call a demo account, then this would be the simplest strategy, is simply wait for a gold to finish the retracement and then buy far out of the money contract, because that's where you're expecting the price to go. So you don't want to put too much money on the table. So if it's wrong and it collapses down, you're not going to lose your shirt, as it were. But if the thing comes right, then you are looking for multiple of your trade multiplying by 10 and 15 times. So that in anybody's book, I think, is a fantastic trade. And every time you put a risk on table, because with this one you cannot lose anymore. If this went completely, if the gold prices collapse and goes to zero, you cannot lose more than what you used to buy the contract. So that's the beauty of it, is that even if you think it's gone further than you were expecting, you don't have to panic out unless your analysis then proves to be wrong. And if it proves to be wrong, we've got a long-term time contract, so we could actually scale out or get out and get partial of the money back. So we won't lose complete $275. You lose some of that. But if you get it right and you do enough of those, then you could have a basket of trades in different markets, all at different stages. For example, some are mature, some are intermediate, some are just beginning, and then you'll be looking to scale some out, for example. So you could have those sort of things, and your capital could grow. And I think it is not unrealistic to say over the space of 12 months to maybe trade a capital that could grow by 5 and 6 times. That's very, very cautious, to possibly 10 and 15 times your initial capital. And you wouldn't in this case go all in and all out either, because as I say, you'll be selective. You'll be putting small position on each of these trades, which will have a different entry point, different timings, different cycle. So they will be at different stages. So you will be spreading this, and I would say on average you wouldn't put more than 50% of your account size actually in active trade. Everything else is sitting on a sideline waiting for opportunities to happen, because when the opportunity happens, you don't want to be running out of cash. So I would say generally only commit 50% of your capital, and all of those capital is with the view that if you're wrong, you don't lose a great deal, but if you're right, then at least it will be 4, 5 times, 6 times minimum to probably more likely 10, 15 times to even higher multiple if you get it really right on a big swings. And big swings are only what I'm saying here. People will use these options for trading intraday and weekly options and all these kind of things, but they're for relatively short move. So you have to be that you can't have a luxury of sticking in a triangle, because you'll be running out of time, and your money will be losing, like a bucket with the big holes in them. So the moment you buy a particular option, it's effectively a wasting asset. So you don't want to be waiting for too long, because you waste too much time, then it's not going to be helping your profit. So the idea would be is if you're looking to buy these and you're only buying short term, then you want to get your movement absolutely right and timing right, and that I think is very hard to do, really hard to do. But on the longer term, you have a luxury of sitting there and basically waiting like a people have analogy of whale, or predatory animal or anything like that. You're waiting in a for a right opportunity, and then because you're monitoring few different markets, you'll have some of them getting ready, so you'll be looking to enter those. Others you're monitoring because you're expecting to get to a certain level, and then you'll start showing interest in them. Until then, there's really nothing much to do. So this sort of thing, I think, is ideal for somebody who don't have the time to sit in front of the computer, trade all day, or want to supplement this trading with something else they're doing actively elsewhere, or basically have a trading capital that they want to really trade well, capitalize on a big trend, but don't want to be stuck to the PC and have a life outside the trading. So any of those kind of situation is where the kind of strategy I'm proposing would really work well. And I am setting up a group of there are quite good number of us have our friends have asked me to see if I could set up a group to help them in conjunction with what I'm trying to do for my own trading capital. So I'm thinking of setting up a group. This group will be relatively small in number, because if I was to spend this kind of time helping the group on demonstrating a particular trading opportunity, explaining the charts, explaining the strategy of which particular option we'll be looking for, these kind of things would be time consuming for me. And so I can't do this on a very large number, but it will be a relatively small group, and they will it will be a subscription based group. So this sort of service can't be delivered completely free, so it'll be reasonable price, I think, for what we are looking to get at the end of the say 12-month trading account. So it'll be subscription group. And for those who are interested, I would say that rather than me go into the details here, is email me. I will post the email in the chat when we finish this. Email me, and I will see, by having a personal chat with you, to see whether this particular strategy would be useful and suitable for you or not right now, or whether you are interested in simply learning and gathering knowledge and skill, so that when you're ready, you might be able to then start applying that in your live account at subsequent stage. So in that case, it might be like an educational program. So either from that point of view, or you are looking actively to start doing demo trading and get a hang of it, and then start doing the live trading when you're ready for it, then on that sort of basis, I will give you my thoughts. And if you feel that is something you want to pursue, then you are at liberty to try and decide that for yourself. No hard pressure, no obligation at all. But if you do decide to join, I think there is a tremendous opportunity, and I won't sort of go into details of all the other market that I'm currently tracking. And in a kind of way that we've done the gold, I've isolated many markets which are likely to give us a fantastic run, on a larger time frame. So I'll be able to share that with the group when we get the group going, and I'm hoping that we would get that going very, very soon, because the market, I think, is nearly ready for topping. For some of you who might have seen my chart that I've posted or shared with you for Dow Jones, which is, for example, let me see if I can share that with you. Dow Jones chart here. It's a chart that I prepared back in December or September 2012, using the same kind of approach and analysis. Where is it? Where is it? It should be here somewhere. Charge or euro. Just bear with me a second. Yeah, this one here. Okay, this one is a chart that I prepared before joining the trading view, where I was expecting the price was here. That was around about September 2012. My upper side of this Dow Jones were between 16 and 17,000, and my time analysis was indicating late 2013 and possibly early 2014. And then my subsequent, when I had some further price action, I then isolated June, July as a possible date for final top in the area of 16 to 17,000. So in this particular chart, either we would have a price drop over the next 12 to 18 months to 2 years, maybe back to the 2009 low, or maybe we would drop a lot further than that, and it won't happen all in a one go. I do understand that, we'll have staircasing effect, but the point I'm making is that if we do get a top here and we even go back to testing 2009 low over the next 2 years, then it's a very similar kind of a trade that we are looking for. Like in a gold, we're looking to go up. How will the fundamentals line up? I don't really know, because it's something that I don't show a great deal of interest, only a cursory interest or a passing interest, but I don't try and harmonize all of these. Sometimes they do, but I don't try and agonize to harmonize fundamentals with what I'm trying to put in my chart. But maybe if the stock market starts collapsing, then maybe people might start going back to gold as a safe haven possibly, and that could be the reason why gold will probably then start going up. And if I'm looking for June, July, then that suggests that on a gold we will be looking for possible late July or sometime mid-July as a possible low forming on gold, when it will be ready for bottoming and going to go up. So I've done analysis where this kind of marketplace are going to come up, and based on this chart prepared back in September 2012, you can see even a date here. Look, 16th of September 2012 is when I actually prepared this particular chart. Is coming to fruition, and if you had this kind of move over here, it could give you incredible amount of opportunity to trade using options without risking a lot of money. And if you get a move like this one, if you buy an option at this place, like the one that we looked at in gold, you have every opportunity of maybe multiplying this capital that we put on here by 20, 30 times by the time it comes even somewhere around 9,000 or 8,000 or something like that. And there are, when you go through the material I outline in these other, like this particular website, you will find that there are various elements to the option pricing, and one of the element, and in fact the one that is very powerful element of the option pricing is the fear factor. So when the price is dropping like this or volatility is expanding, the fear is so great that the option prices pump up. So option prices are made up of the fear and the volatility factor. So if it's very high, then besides the price actually moving in your direction, you've also got a fear factor and volatility in your favor. So your option prices could really multiply in the way that you don't even imagine. So that's why when we are saying that the price dropped from 17,000 to even at 10,000, it's not impossible to expect your option multiplying by 15 to 20 times the value, and that could happen in a space of 8-9 months. I mean, this drop took 17 months. So if you come halfway, 7-8 months, we drop half the amount. So if we drop from there to something like over here, that could easily happen in 7-8 months, and that means your option that you buy for that position out of the money could easily be 7, 8, 10 times the value. So that's a potential. I'm not promising that, but that's a potential that we would explore. And I think it will be an exciting project. If any of you feel you like to join, then contact me at my email, and the email is trading charts. So let me type that in: trading charts number 4 wealth at gmail.com. Okay, so that's an email. So send me an email there, and then we can get together and have a discussion to see whether this is something you want to follow now or later. Is it suitable, etc. Before you make up your mind. And would be happy to have a conversation. But in the meantime, let's see if there are any questions or points you want me to clarify as far as this presentation is concerned. And you can interact with me by posting your comments or questions in the trading room chat. Trading the waves in that trading chat. So I'll give you a few moments to see if you have any questions in there. Is anybody with me? Have I lost you all? Okay, well, I'm not seeing any responses, so I'm not sure whether you all still with me or you've can I have any indication to say that you're still with me? Are you able to hear and see my charts? Okay, well, looks like there's no questions coming through. For those of you who visit the trading view, for example, where my this here. If you click onto that, you'll see able to type your questions in if you have a question. But maybe if the material is rather new for you, it will take a while for you to sink in. And I certainly encourage you to read through the materials, these free resources here, for example, that will give you the background to generally get your head around of what I'm trying to say. But it may not be that easy to actually get everything all in a one go. But hopefully over a period you'll try and get a general idea of what the options do and how they work in order to apply them. But then if you want to try and test the strategies out, then this Trade Monster is a great site, unlimited trading for demo account, and you can do the sort of thing that I was doing, and try and see how it works on a demo account. That's the other way to experiment with it. And if any of you, whether you decide to join or not, doesn't matter. If any of you have a specific question and you feel that I can help you with, then I'll be more than happy to have a short one-to-one with you, either by email interaction, or maybe we'll fix up a suitable method. Okay, so great. Well, if there's no immediate question from anybody, then I will conclude this session here. It will be recorded on the Google Hangout, so you'll have an opportunity of reviewing some of that, and hopefully that you've at least seen a possibility, if not entirely with me on everything, but at least seen a possibility that it may be an area that could be fruitful and might require some digging into if you want to develop an interest in that area. Okay. Well, thank you very much. Thank you all for being with me. Appreciate that, and hope that you found something useful. And with that, I will bring this session to an end. To bring it to an end. Where do I go? Oh, here. Okay. So stop broadcasting.